So 2 months ago, Adam Khoo has announced that he has sold out of his entire Tencent position.
But on Friday, surprise, we're starting again. We're cracking down on the internet sector, specifically the gaming sector, stopping people from spending too much money on games. Well, that's the final straw. For that reason, I'm done. I sold all my Tencent shares and I'm not touching any more China stocks.
So recently, Professor Damodaran actually went onto Professor Galloway's podcast and alluded that he actually added to his position in Tencent.
Today's prices, I would buy Tencent, but I wouldn't buy Chinese equities in a bag because I can get a lot of crap with the good stuff.
So what's going on? Coincidentally, I happen to hold shares of Tencent as well. So I'm really just being careful with my words here. I say that I hold shares of Tencent, and that does not mean that I'm a shareholder of Tencent. So you'll know why later on. So in this video, I'll share where I stand with Tencent today. So full disclosure, these are the screenshots of my Tencent position, and it makes up right around 13% of my portfolio, accurate as of 16th of February 2024. So of course, I'll be biased since I'm a backholder. So technically, I'm green on the position right now, but who knows? A new regulation approval tomorrow might make the company disappear. I'm just joking, of course. So let's get back to business. I'll give you a quick refresher on why Adam has actually sold his Tencent position. I think it mainly revolves around three key areas: incoherence on regulatory stance, structural misalignment, and opportunity costs. So let's first tackle incoherence. So if you haven't been following, the Chinese stock market have been struggling since 2020 and 2021. And in total, they've lost investors nearly 6.3 trillion US dollars in market value over the 3-year period from its peak. So specifically for Tencent, it was a tough journey for them. So in 2021, China actually restricted minors from gaming more than 3 hours per week. So theoretically, if you game lesser, I have lesser chance to serve you ads, lesser touch points to get you addicted to the game and make in-game purchases by extension, and lesser time to train your gaming habit so that you will spend money in the future after you have spending power. Thereby, I'm shortening the customer lifetime value. Overall, it was deemed to be of adverse impact to Tencent's gaming business because hey, they are the largest gaming company in China and in the world. However, Tencent easily bounced back from that because the bottom line impact was minimal, as kids were not the main revenue generator. But I do think that we need a much longer time to accurately determine the extent of the ban. To add fuel to the fire, China has also suspended approvals of new video games for about 8 months, citing gaming addiction concerns, further impeding Tencent's ability to innovate and also to expand. And here comes the incoherence. So after a 2-year-long ordeal, it seems like China was once again ready in 2023 to embrace the tech companies after the regulatory overhaul. And you can see headlines such as this: Chinese local government roll out the red carpet for big tech firms as Beijing shifts stance. So China's Xi Jinping focuses on tech innovation during the first Shanghai visit in 3 years. And most importantly, NetEase amongst the latest to receive approval from China's video game regulators as industry recovers. So given this transition in regulatory stance, investors were once again hopeful, as it felt like finally everything was coming to an end. And of course, China does not want anything good to happen. On 22nd of December 2023, the top gaming regulator actually published draft rules broadly to clamp down on practices that encourages players to spend more money and time online. And that news alone has sent Tencent down 12% in a day, because this was an explicit impact on their future profitability and also future growth. And let's not forget, the market is forward-looking in nature, and multiple essentially got crushed because of this bleak future outlook. And that was also when Adam has sold out of his position. So investors' confidence were once again being challenged and it was shattered. So it was the last straw that broke the camel's back. And Adam has had enough of the government's circus show. So I hope that this provided enough context of what has transpired thus far. So for the other 2 points, I think it's fairly simple. On the second point around opportunity costs, I think Adam has been rather transparent with his past performances in the equities market. So he has been outperforming the index even with Chinese stocks in the portfolio. And he probably felt that it was a waste of time to continue playing this charades or tug of war with the regulators, and he just wanted to move on. And the third point, which is structural misalignment. So generally, there is a different attitude towards capital providers in the US versus China. Full stop. So the Chinese government places more emphasis on taking care of the people and sacrificing anyone or anything that gets in their way. The US, on the other hand, sacrifices the people. Sorry, of course that's not what I meant. I'm joking, by the way. So they focus on strengthening the system and allowing nature to take its course. Which brings me to Professor Damodaran. So he essentially shared his thoughts on the rude awakening of investors and shareholders' interests in the Chinese market.
And yet the Chinese corporate governance system, which has nothing to do with shareholders, and the power rests with management, with Beijing being in the room with every company's management. And I said, look, when times are good, corporate governance systems look great. The way you test a corporate governance system is not when times are good, but when times are bad. When China was growing 10, 11, 12% a year in real terms, the weaknesses of their governance system kind of got hidden. But that buffer is gone. And I think what you've seen, it's not just in the last year or two. I go back to when Beijing cracked down on the big Chinese tech companies, Tencent, Alibaba. They claimed to do it because they cared about consumers. If you think Beijing cares about consumers, then you're being naive. I mean, this is a government that cares about one thing and one thing alone, which is control. And I think what you're seeing playing out in the Chinese market is people recognizing how little power they have in companies, how opaque these companies are, and how much you don't know in big publicly traded Chinese companies. And I think that fear factor is driving prices down. And I don't blame investors because you really don't know what you're getting with a Chinese company. Now, it's not the old Buffett description of you're buying a share of a business. You're definitely not buying a share of a business when you buy shares in any big Chinese company. You're a capital provider, and that's how they treat you. You gave us the capital. We'll do what we want with this capital, and don't you dare push back.
So like he said, our main job scope is to provide capital. This then ties back to my opening where I said that I own shares of Tencent, but I'm not necessarily a shareholder of Tencent. Because you can't necessarily apply the same definition of being a shareholder of a company in the US versus a Chinese company. Now, I'll play a short clip where despite this context and lack of rights as argued by Prof. Damodaran, he still added to his Tencent position.
I would avoid the Chinese companies with significant amounts of debt because that's where the opacity comes out of Chinese companies is how much do you owe? Are you really in good financial position? I'd avoid Chinese companies with significant real estate holdings because there the pricing adjustments are going to play out. But they're really good Chinese businesses. I like Tencent as a company. I like it as a company because it's built an amazing platform, a platform that people use for everything. And I think at today's prices, I would buy Tencent, but I wouldn't buy Chinese equities in a bag because I can get a lot of crap with the good stuff. So if you're going to go into the Chinese market, do it selectively. Pick companies that you understand what they do, what their business is. Don't pick these opaque companies which claim to make a lot of money, but you're not sure what the business is. And I think that you can get some good investments to add on, but do it with open eyes, which is you're never going to have much shareholder power of these companies, ever.
So it's interesting, isn't it? The logical conclusion after hearing Damodaran for the first part is to stay clear of the Chinese market. Why even bother? But clearly, that wasn't the case. I don't happen to be friends with him, so I won't speculate on what influenced his decision. And I'll just like to keep this as an open question for you guys to think about. Now, let me try to share my side of the story. So I'll share my views around Tencent today that maybe current or even prospective investors would like to hear, and subsequently what I'm looking out for in the medium to long term. First, on the policy flip-flop. So I've spent quite some effort to explain the context of the gaming crackdown over the last 3 years, but I've left out part 2 of the story. Not too long after the new draft rules were released to the public at the tail end of 2023, the head of the publishing unit that was responsible for this publication was removed from his position. So it might be a telltale sign that there was a lack in communication and somebody had to pay for this blunder. So it's essentially like the left hand doesn't know what the right hand is doing. So despite the removal, investors' confidence are already at an all-time low and trust has already been broken. And it's probably close to impossible to convince someone like Adam to put his monies into Tencent again. Also, it's too early to declare victory around this new piece of regulation on gaming addiction, because it was meant to be a draft to solicit opinion from the public in the first place. So we have to wait and see the final decision from the officials. So I like how the founder of RateGate Asset Management puts it. So as a China manager, we are not scared by Western sanctions. We accept that it is a process allowing China to learn and to grow. However, we are frightened by our own policy changes. No one wants to live and work in an environment of uncertainties, with policy crackdowns in week 1, followed by 5 supportive methods in week 2. So we don't expect Chinese ministries and commissions to operate as precise as PBOC. But given the size of Chinese economy, please don't behave as if you are running a small village. So I think this pretty much sums up the angst and common consensus amongst the capital allocators in China today. So it's a pretty loaded statement, but I think it's a feedback worth considering, especially for those in power. So to supplement the point, I share the same view as Howard Marks on the capacity, potential, and characteristics of China today. I'll play a short clip.
Europe and Japan are economic senior citizens, not much vitality. The US is a mature economic adult, doing fine, but I would argue that the best decades are behind us. China is an economic adolescent. And if you've ever had an adolescent in your house, as I have, then you know it can be tempestuous. And there are ups and downs. But you also know that the adolescent's best decades lie ahead. And I describe China as an adolescent, economically speaking.
This then blends well to the next critical point, the structural incentive or disincentive of the Chinese system today. So what do regulators, government officials, and decision makers want to achieve at the end of the day? Of course, different people in different positions of the hierarchy has different incentives. That said, in general, I do agree with Howard Marks' assessment on China having the motivation and the potential to compete at the world stage. So when we circle back to the idea of us being purely capital allocators, there are definitely elements of truth in it. China wants to leverage on other people's money to build and also to scale their economy and businesses, yet at the same time retain control. So it's two sides of the same coin. In my opinion, the scholars that created the Chinese system are not stupid either. If investors are to provide capital and take risks without an appropriate level of compensation in the long run, the system would not be sustainable. So presumably, if the Chinese are really long-term thinkers, they will continue to build up and beefen up their financial system. In short, they're not necessarily here with the intention of killing their businesses. They're still experimenting with ways of compromising and delivery. Therefore, the adolescence comment. So this is streaking in post-editing. So I think I've forgotten to mention something. If you were to really dig deeper into how Adam and Prof. Damodaran has actually looked into this whole idea about investing in Tencent today, they're basically saying the same thing. However, one person is much more comfortable taking the risk because he feels like he's being compensated and the premium is justified, while the other just wouldn't want the hassle. So I guess it's really ultimately up to you to decide on whether you think this risk reward is suitable and it's comfortable for your own investment decision framework. So yeah, jumping right back into the video. Lastly, I wanted to focus back the attention on the business itself. So Tencent, based on the last quarter, still has 1.33 billion monthly active users on Weixin and WeChat. So that's the entire Chinese population on its messaging app, and there is no close competitor. So when you look at their earnings presentation, they always feed investors with this cog machine. Weixin and WeChat is and will be the mode of Tencent in the near future and in the distant future. And as far as I'm concerned, they have no close competitor. So on the specific breakdown, fintech and business services make up roughly 1/3 of the revenue. Social network and online advertising is slightly more than 1/3, while gaming makes up slightly less than 1/3. And of the gaming revenue portion, 70% is domestic, while 30% is international. So what does this mean for Tencent moving forward? It means that we better be watching clearly on how this new regulation is going to impact their growth and also margins. So on domestic games specifically, they make up around 15% of their total revenue, and they're at around $120 billion RMB run rate in 2022. So with the new regulations still being a huge question mark, everything we project forward will be a speculation at best, because the exact regulations are not even out. But that said, these are the few core principles that we know of around Tencent as a business today. Number 1. Tencent is a behemoth in China today. The biggest social network and gaming company, a duopoly in fintech, top 4 in advertising, top 4 in cloud. Number 2. The management team has a long track record of executing and innovating with the regulators. Number 3. Capital allocation in early investments have paid off wonderfully. Number 4. The management team is committed to taking care of shareholders through share buybacks because of the dirt cheap valuation and issuing our special dividends over the last 2 years, like JD.com and Meituan, realizing real shareholder value. Number 5. The company don't seem to be stopping despite all the doom and gloom around the Chinese story today. The only downside, it's a Chinese company. If not, you'll probably never have the chance to buy such a business at a PE of 13 and a price to free cash flow of 12. So I see this as an opportunity to buy a high quality business at such a cheap valuation as China figure things out, while some others might see it as a trap where you will never realize its value. So I'll leave it up to you to decide. With that, I'll see you in the next video, but more importantly, I'll see you on the moon. Goodbye!